LISC is a national intermediary that works around the country to build sustainable communities. And building sustainable communities means improving the physical community. It means creating a safe community, a healthy community, and also improving the economic development in the community and the family income and wealth there. The work that I do that links directly to financial capability is actually with our Financial Opportunity Center program, which integrates employment counseling with financial coaching and access to public benefits or work supports to make sure that everybody who comes through our doors has enough money at the end of the month to build assets to save. And to really move into a pathway of both financial stability and financial capability. What's really unique about the Financial Opportunity Center program is that each organization is different, and this model of services has worked in many different platforms. It's worked on top of workforce delivery organizations. It has worked in housing groups, housing counseling groups, housing authorities, community action agencies, and also large social service agencies. And so it's worked well in many different formats. And I think what we're finding is that services can't be provided in a vacuum, no matter what type of organization you are. And that if you're only addressing one part of a budget, if you're only looking at income through employment, or you're only looking at expenses or benefits, then that's not really getting to financial stability. And without financial education and financial coaching, you're not making that next leap into financial capability. Another piece, a policy changer, an overall viewpoint that I think we need to start focusing on is that building assets is wonderful, but without building credit at the same time, you're actually doing some long-term damage to the folks that we work with. And specifically, if you are looking at some of the IDA programs, which do some wonderful, wonderful work, if it's not also setting up the participant to have a high credit score, they may end up in a loan where they end up paying much, much more money over time. And so the cost of low credit is something that really cannot be ignored. Credit shouldn't be ignored no matter what the income level is. We know that the cost of low credit over a lifetime is around $200,000, but that's just with what we can measure. If you look at the cost of getting a car payment or a car loan or a mortgage, it also can cost employment because we know that 55% of employers have admitted to looking at credit scores, and it can cost things like being able to access a cell phone. You may not even be able to get a cell phone without a big down payment. So there's this hidden cost of low credit that really needs to be raised up and talked about, and it needs to not be a discussion around credit repair because it's more than that. It's credit building, which is improving credit over time and realizing that credit is an asset. Credit Builders Alliance has really been lifting this up, and I think that they're doing a wonderful job to do that. And I think we also need to do that in the overall policy sphere, is that just recognize that credit is an asset that we should be building for everybody that we work for.